The past week, the rand has been acting like a very sick patient, and today touched a 3.5-year low against the dollar at 8.99 rand per dollar. The question being posed to investors is whether this is a temporary malaise or one indicative of deeper problems in our society. Tony Bell from Vunani Fund Managers joins us from Cape Town in our studio to weigh in on this question. Tony, if the rand were a thermometer, where would you think that liquid mercury is touching? Is that the right at the top, or is that somewhere in the middle, or is just slightly lukewarm?
Godfrey, I'd say at the moment it's a warning shot across the bow. I think the currency is always a reflection of a composite of very complex forces that drive a currency. The rand is a very liquid and highly traded market. So when we see big moves in the currency like this, we as professional portfolio managers pay a lot of attention, because it indicates that there's a skewness in the balance between the people who want to buy the currency and the folk who are interested in selling the currency. What we've seen today on the markets just before I came away for this recording is you're seeing quite a lot of aggressive selling by foreign investors, and I think they're skittish. They're hearing a lot of reports about South Africa's deteriorating investment climate, and in the short term we're probably going to live with a week or two of a bumpy rand, and as your previous guest said, who knows where we go to from there. But I think at a broader level there are a lot of big policy issues that have started to weigh in on the debate, and the recent surveys by companies such as Grant Thornton, which look at the competitive position of South Africa and the policy environment and their rate relative to other countries, has put South Africa in a particularly challenging light vis-a-vis other countries like Singapore that are ranked at the top of the tables.
Yeah, I suppose the question for every fund manager and every investor is, of course, what will happen tomorrow, and for that no one has answers, but we try collectively to try and find the answers. From where you stand, what sort of time frames are we talking about here in terms of just how far worse things could go for the rand, and what sort of ranges would be in your mind?
Yeah, I think perhaps to put a slightly different spin on the comment that you may expect, a lot of the broker research that I'm seeing coming across my desk at the moment is talking about the rand up at 950, 960, and a lot of it is based on estimates of where people think the currency could go to. I found over time that it's very, very hard to be so prescriptive about an issue like a currency, and I try and answer your question in the context of what's now commonly referred to as QE3 in the States. Dr. Bernanke has indicated that he is going to engage in open-ended monetary easing, and if you go back to his speech in November 2002, he talks very specifically to one of the objectives of unlimited monetary easing being a weakening of the dollar. So we need to, I think, look at the rand debate in the context of the dollar debate. Some folk are calling it currency wars. I think I prefer just to refer to it as competitive devaluation, as a macro policy that's allowing policy makers the opportunity to put their currency out there first in a competitive devaluation cycle so that that country becomes more competitive. We know, for example, that the euro would be in far less of a stressed position if certain countries like Greece, Spain, Portugal, Italy could have had that flexibility as part of the debt resolution crisis to have their currencies weakened, but of course they can't because they're penned in or hemmed into a common currency. So it's not obvious to me that the rand is a one-way bet south, as has been the case in the past, because the reserve currency of the world is moving into a very aggressive easing policy, and that's going to mean a weaker dollar. So whilst the rand might be weak, it's certainly not going to be as weak as it otherwise would have been the case in the past, and that's how I see it.
Tony, just to talk about that, just to touch on that for a second before we turn our attention to how South Africa ranks as a global economy. The US position has always been, or previously had been, to maintain a strong dollar. And now it seems that Ben Bernanke on his own, almost unilaterally without any input from the federal government, has taken a position to increase the money stimulus. So does this signal a change in thinking for the United States in having a dollar that's weaker across the board?
It's a really interesting question, Warren, because if you again go back to what I call the checklist speech of November 2002, Dr. Bernanke is doing exactly what he said he would do in these circumstances. I think what might have caught a lot of folk by surprise is the extent to which he was prepared to make QE3 open-ended. And I think that's really what has taken market commentators a little bit by surprise. I'm not sure that it's a deviation of policy within the Fed, because way back as far as the 2002 speech, he spoke at length about buying other asset classes, and he cited mortgages specifically in order to try and ease the burden of banks holding unperforming or non-performing loans and providing them with the capital necessary in order to get the credit cycle going again. So I would argue he's been quite consistent with the stated policy of the past. Of course, there might be disagreement within the Fed as to what the appropriate course of action is, but I think he's running true to script.
Tony, just to talk about the implications for inflation in the US and obviously around the world, it's great fun unloading I think about $8 trillion into the monetary system through the quantitative easing the Federal Reserve has embarked on. But there is a chance that you create an 800-pound gorilla in the form of inflation that will come back or appear in the next few years. What's your sort of understanding and view on inflation for the investor both in US equity markets and in our own?
Yeah. Warren, nice question. What we find when we do the analysis is that the analysis suggests a completely different view from what we would perhaps refer to as the common concern of too much money creating too much inflation down the road. There's a concept in economics called the velocity of money, and that's just simply how many times you need to take at $1 to produce a single unit of output. And at the moment, because of the lack of final demand, Dr. Bernanke's main concern, we would argue, is not inflation, but in fact the opposite. He's still dealing with the spectre of deflationary pressures because the US consumer has not yet got themselves to a position where final demand can be sustained. The most obvious example I can give you is the collapse in final demand in the southern part of Europe. A year or two ago, when Mr. Trichet was running the ECB, inflation was cited as the number one enemy. But yet it turns out that there is such a paucity of final demand in the southern European states that deflation was the real issue, not inflation. So without making it overly complicated, we see inflation as being less of a problem than deflation until such time as final demand starts to pick up in the states. And in simple terms, the economy can get itself onto a bit of sustainable recovery and get traction in underlying demand. We don't see that yet. South Africa is a slightly different position. South Africa's got a high imported inflation component when the economy starts to grow. I think Charles Booth commented a little bit on that in the previous slot on the deterioration in the balance of payments current account. And we see that as being a really big issue for the South African Reserve Bank to deal with. Governor Marcus, in her two recent speeches, has become slightly more concerned to a point of almost being slightly alarmist at the deterioration in the balance of payments current account and the pressures that are external to South Africa that are going to cause inflation to rise. So lower exports to Europe mean less revenue. The mine strikes aren't helping because that's causing quite a setback in terms of the revenue from the mining operations. And at the same time, you've got the rand weakening, which makes our energy and our petrol prices more expensive, particularly as far as imported oil is concerned. So you've got a lot of cost push pressures in South Africa, which are going to create a little bit of a headache for the Reserve Bank, because the natural inclination would be to follow the central banks of Europe and the States to potentially drop interest rates to underpin final demand, but yet they've got the spectre of much higher inflation to contend with, which is why Minister or Governor Marcus is being a lot more conservative in her monetary policy stance than she otherwise would have been.
Yeah. So what are you saying, Tony? Are you saying that the governor then shouldn't cut it the next one? In fact, we should perhaps stay where we are? And also another message I'm picking up from you, you're suggesting that we should actually be celebrating the weaker rand rather than trying to fight it, because as you say, the world out there is inclining towards competitive devaluations.
Sure. Godfrey, it's a really interesting question because, and I think one always, in this world's become a lot more complicated and one needs to tease out the nuances of the issues. A weaker rand makes South Africa more competitive. South Africa has been losing a lot of competitiveness in relation to many of its international competitors, China, for example, Korea, India. All these countries are taking market share away from South Africa in terms of our ability to compete. And even if you have a look at the mining sector, notwithstanding the latest round of wage demands, we've been losing competitive edge in the mining sector as well. So on the one hand, the weaker rand makes South Africa more competitive.
Yeah.
On the other hand, it pushes up the cost of our imported goods, which makes our cost of living more expensive. And it's that balance that Governor Marcus has to achieve against the background of the stated Fed policy of a weaker dollar. It does make central banks' jobs a lot more difficult because it's a little bit of a double-edged sword. You don't want to have too much weakness in the rand because then you bring too much inflation into the equation, and that's not necessarily good either.
Yeah, and the problem is, of course, then how do you balance all that together? Tony Bell from Vunani Fund Managers, thanks very much indeed for joining us.